All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. If you've been searching the internet looking for information on investing in real estate using life insurance, you've come to the right place. So be sure to bookmark this channel right now. You'll want to come back. Today I'm digging deep into the Double Play archives again to produce a video that I recorded years ago, but I wanted to show you guys some of the common tricks that agents can use when they're running illustrations that can bias the numbers one way or the other. So this is a what you should look for on your policy illustrations, the tricks that you should look for. So with that, I'll jump off and let the rest of the video continue with the video that I recorded years ago. All right, thanks for sticking around. I'm Tom Rutkowski with Innovative Retirement Strategies, and the goal of this channel is to give you the tools that you need without ever talking to an agent to get the most efficiently designed policy possible for the Double Play. So today I'm going to give you 4 common tricks that agents use when they're doing illustrations. 2 of these are tricks that will actually put more money in the agent's pocket and give you a less than optimal policy design. And the last 2 are just tricks that they use to get their illustrations to stand out relative to other agents. All right, so we're going to be taking a pretty deep dive into life insurance today. So I'd highly recommend that you go back and watch the Life Insurance 101 video that I've done. And if you've got an interest in the Double Play itself, there's other videos that specifically deal with the Double Play and how it works. Today, I just want to deal with the 4 common tricks that insurance agents use when they're doing illustrations. With that, let's get started. So the first trick is not necessarily a trick, but in order for you to make sure that you're getting the best optimized policy design and the agent isn't getting a higher commission, it's important to understand that overfunded doesn't necessarily mean maximum overfunded life insurance. A lot of the illustrations that you'll see from the private banking types like infinite banking, bank on yourself, be your own bank, these are typically policies that have a much higher death benefit than the absolute minimum. And when you look at the ratio of cash value to premium in these policies, you can see that it's around 65%. And that means that every dollar of premium you put into the policy, you're getting about 35 cents lost just for the cost of the policy itself and the cost of insurance. If the policy is properly designed and you've got minimum death benefit, maximum cash value, you should have about 85% cash value to premium. So when you're looking at an illustration, you should be looking at something that shows the premium and then cash value of about 85%. And surrender value, mind you. So let's take a look at an example of what I'm talking about. If you take a look at the screen right now, what I have on screen is an extract from an actual illustration. This is a potential insured who is 32 years old. The policy owner is putting in $100,000 of premium for 5 years. So if you direct your attention to the cells that I've got highlighted in orange, you can see the premium of $100,000, and off to the side of that you can see the accumulation value and the surrender value. And you'll notice that both of those are $92,777. So almost $93,000 of cash value from the $100,000. And it's important to note that this illustration, almost all illustrations, are showing the end of year values. So what you're looking at here is the cash value after the first year's dividend or interest crediting has occurred. So in this case here, we're looking at an interest crediting of 5.69%. So if you back out that growth that has been credited to the cash value, now you're back to the cash value that would have been in the policy from day one after all the expenses were taken out. So that gets you back closer to the 85% number that you'll notice me quoting in these presentations. All right, so moving on, the next trick that we want to look at is, and this is not always a trick, mind you. A lot of times this can be the fault of an agent who just simply doesn't know the damage that he's causing to a client, or he knows what he's doing and he's happy to take the money that he's getting extra here. So the point I want to get across here is life insurance is scalable. So if you can picture paying a premium on a policy that has an annual premium of $10,000 a year, and that policy may have a death benefit of $500,000, depending on how old the client would be. Well, life insurance is scalable. So if we doubled the premium from $10,000 to $20,000, we should expect that the death benefit would double from $500,000 to $1 million. And the cash value would be twice as much, and all the policy fees and expenses would be twice as much. So really, under the hood, what's happening is that the software is pricing out the lowest possible death benefit that you can get based on that $10,000 premium or $20,000 premium. And unfortunately, the costs in the policy are spread out over 10 years. So if you were to start with let's just say you've got $10,000 in the bank and you can afford $10,000 a year in premium. So you might be tempted to put $20,000 of premium into a policy the first year, followed by $10,000 a year thereafter, right? That sounds like a great way to get your cash in the policy and working. But the way life insurance works is the death benefit is a function of the first year's premium. So you would solve for the lowest possible premium that you can, or cash death benefit that you can get on $20,000 of premium. So if that's $1 million death benefit, you've got the costs associated with the $20 million. You've got the costs associated with that $1 million death benefit. But the problem is that in the subsequent years, when you're only putting in $10,000 of premium, you've got the same costs that are eating away at that premium. So as you'll see here when I look at an example, you'll see that the costs are taking up a much greater percentage of those following year's premiums than the 85% that we're talking about. So the 85% cash value to premium that I talked about in the previous example, that's a good first look at it. But you've also got to make sure that that holds true across the rest of the years. And really, you can only do that on an IUL when you have access to the cost report. So to change gears, this is also true when you have a policy where the agent, again, thinking that he may be doing a favor for you, designs premium increases into the policy later in the year. I mean, let's face it, people's incomes go up over time, and while doing a policy with $1,000 a month premium may seem like a lot today, in a few years when other bills are taken care of, your house is paid off, you might be able to put even more in. But the problem is, again, the software and the underwriters are basically approving that increase in the death benefit at a later time. And that cycles back to the costs involved in the policy because they're underwriting that larger death benefit. So if you're a real estate investor and you want to get a policy that is efficiently designed where as much of every dollar possible is going to the cash value, you want to have a policy where the premiums are level. Even though you could afford to put more in later or upfront, you don't want to do that. You want your premiums to be level. You can always go back later and apply for that death benefit, and you'll have to be approved for it at that time. That's the best way to do it. And if you're afraid of not, well, you could wake up one day and you might have a disease that would prevent you from getting insurance. So the way you can protect that is by buying a term policy that's convertible to a permanent policy. And that would be much, much less expensive for you than being underwritten and having those costs for the permanent policy from the get-go. So again, level premiums throughout. No lump sums up front and no increases in the death benefit in the illustration later. It's fine to increase the death benefit on your own whenever you're ready for it. Just don't design it into the illustration because then you're going to be approved for that. So let's take a look at an example. In this example, we've got an insured who's 45 years old and is putting $36,000 a year into the policy the first year, followed by $12,000 a year each thereafter. So you're looking at the column labeled premium outlay. And then to the right of that, you've got the costs in the policy illustrated. So you've got the premium charge, the cost of insurance charge, the policy issue charge, and additional charges. And the first year, if you look at the row starting with age 45, you'll see that the total cost, there's $1,980 for the premium charge, $240 for the cost of insurance, and $2,292 for the policy issue charge. So if you add all those up, you got almost $2,300 plus a $2,000, so 42, and it's about a pretty decent sized chunk, over $4,000 of expenses for that first year. But if you look across to the cash value, the last column there, you got $33,000 at the end of the year out of that $36,000 premium. So those are very attractive numbers, right? They're in line with the 85% rule that I mentioned. But now direct your attention to the rows underneath it, where the subsequent lower premiums of $12,000 are coming in. Now here, if you look to the right, you'll see that the policy issue charge is still that $2,292, almost $2,300 every single year, all the way through year 10. And some carriers do it out through the 15th year. They might be a lower amount, but it's for 15 years instead of 10. So if you look at the premium charge and the cost of insurance charge, $660, $400, you've got almost $1,000 there plus $2,300, so about $3,300, maybe $3,400 if you round up for the additional charges. But $3,400 as a percentage of $12,000 of premium is well in excess of 25% of that premium is going towards charges. So if you understand that that's occurring for the next 9 years, this client is giving a very large amount of that initial large premium back to the insurance company, and because of the extra fees involved, because of that higher death benefit that they were underwritten for. So again, if you want an optimally designed policy, have it done with level premiums throughout. It can be for as short as 5 years, like I showed earlier, or all the way out through the rest of your life. But level premiums. You can always go back and apply for the death benefit later. Now, if you want more information on this, a little bit more detail, I do have an ebook that's available in the store on my website. It's just a whopping $5, so you can go in there and download that. And it's got a much more information than what I've covered here. So be sure to check that out. All right, so the next thing I want to talk about are the growth rate assumptions. Now here we're into the area where this isn't going to cost you money, but what I want is for you to have the ability to look at life insurance illustrations on an apples-to-apples basis. If you've got 3 illustrations sitting in front of you from 3 different agents and 3 different companies, you want to know which one is the best. So the way to do that is to make sure that all of the inputs are apples to apples. So all 3 agents use the exact same growth rate, because clearly if one agent is illustrating growth of say 7% and one is illustrating growth of 6%, it's that growth rate that's going to make the difference between one looking better than the other. But in the real world, all IULs kind of work the same way, right? They are taking the income that they make on their general fund, using it to buy options on an underlying index, and trying to capture as much movement in the market index as they can get. So what they're really after is just a premium over the debt market rate of return, which is the assets that they have in their general fund. So what you really want to have is just, regardless of what the agent may think one particular strategy may do compared to another one, just set the inputs to be the same. And then that way if the premium is the same, the growth rate is the same, then any differences that you see on the illustration will come down to the underlying cost of the policy. If company A's has got less cash value than company B's for the exact same premium with the same exact growth rate, then there's a difference in underlying costs in that policy. So the one that looks better, regardless of the growth rate, is the one that's got better growth potential with lower costs. The next thing is on the whole life side too. There are companies out there today that are, and today being December of 2020, this video might be up on YouTube for 100 years. So if you're watching it 100 years from now, In December of 2020, we've got near historic low interest rates in the economy. So the insurance companies, as they take in premium, and they're basically using that money to invest to have each insured save up their death benefit. They're investing that money in bonds and treasuries, and they're buying tons of mortgages off the banks, preferred stocks, and that portfolio is earning income. And that income is then credited to each policy in the form of a dividend. So it comes down to, if they're showing 6%, where are they investing their money that they're earning 6% in today's market? I mean, if you go out and you search on the Moody's corporate bond yield for high quality debt, you're going to find that it's under 3%. So the money they're investing today is barely earning enough to even come close to earning the guaranteed rate, let alone 6%. So keep that in the back of your mind as you're looking at an illustration that's showing a 6.2% dividend for the rest of your life. It's just very unlikely in today's market that the insurance companies can continue to maintain and pay a 6.2% dividend. So it's not going to hurt anything to have the illustration run with a lower rate to just show you what the policy will look like or perform like if the growth rate was that low. I mean, growth rates can come back in the future, but it's important to understand that the growth that occurs in the first couple of years is key, because that's the money in the policy that's going to be growing and compounding the longest. So it's very heavily weighted towards those numbers. So one other thing in the case of an IUL is a lot of companies will have what are called leveraged strategies. And what leveraged strategies are, in exchange for a fee based on the amount of cash value that you have, you can give the insurance company more money so that they can use it to hedge and buy more options, which allow you to basically buy yourself a higher cap. And the higher cap, if you look back through history, you might find that there's a higher yield because you had a higher cap. But the insurance companies use those higher rates to illustrate when they're doing illustrations. So you might have a company which showing you an 8% growth rate, and you might be comparing that to a XYZ company that's showing a reasonable 5.5% growth rate. And you're thinking, wow, these guys got something really spectacular here. And that might be true, but here's the thing with these leveraged interest crediting strategies. That fee is assessed every single year, whether the market goes up or down. And as you know, in Index Universal Life, you have a cap and a floor. So if the markets go up, you can earn whatever the market gets up to that cap. And with interest rates so low, the insurance companies have less money to spend on hedging, so they can't buy as high a cap. So caps are down right now. So if you buy a higher cap and the market goes down, that means that you basically spent that asset-based fee and didn't get anything for it. Or if the market goes up to the old cap but doesn't reach the new cap, again, you spent that money on the fee, on the higher cap, but you didn't take advantage of it. So it really only adds value when it beats the new cap that you receive. In any other year where it's between the new cap and the old cap, or markets go down, you're just not getting your bang for the buck on that. Now, that said, if you apply that higher cap back through time, the numbers will show that it probably works out. But there are a lot of little old ladies and people who don't understand that this product has the ability to go backwards, that the cash value has the ability to go backwards. And that's not always a good thing to put a sophisticated interest crediting strategy in the hands of somebody that doesn't understand it. And especially coming from an agent who doesn't understand enough to present it well to his client. So be careful of higher assumptions on growth and due to these leverage strategies. Really, in today's market with, again, December of 2020, you should be looking at 5.5% as a cap on an IUL. you should be looking at 5.5% as the estimated annualized growth rate over time. The cap might be 8 or 9%, but there are going to be years where you get zeros. There are going to be years where you get 8 or 9%, but it should average out over a longer period of time to about 5.5. Now, and that said, interest rates will go up in the future, so they're not going to be at the lows where they're at today forever. So as interest rates go back up, you'll find that the caps will go back up and your policy will probably be earning more in the future. But right now, as you're looking forward, it's again, that's the money that's going to be in your policy the longest. So that's the money that you want to make sure you do your projections based on that. All right, and the last trick that we want to look at is the retirement income projections. So when an agent is showing the policy generating tax-free retirement income via policy loans, so you're borrowing against your policy's cash value, so the cash value itself is the collateral for the loans that you're taking. So as with anything, if you assume that you're retiring and taking it for 10 years or 20 years or for the rest of your life, clearly the income projections will be going down the longer you stretch out the income, because you're going to be tapping into your collateral each year as you take income. So be sure when you're looking at an illustration that the income projections are all based on the same exact time period. And honestly, I prefer to do my illustrations with income shown all the way out to age 120. So basically, I can tell somebody with all honesty that you will have this amount of income for the rest of your life, no matter how long you live. You'll never run the risk of running on a collateral to borrow against for tax-free retirement income. All right, so wrapping up, basically, if you're not a life insurance agent, you probably don't know this well enough to know what to look for. So this video is really for those of you who have an illustration in your hand and you're looking at it and you want to make sure that that the wool isn't being pulled over your eyes. So I hope I've given you some tools that you can use to take a look at the illustration and just make sure that company A is comparable to company B. But in any case, I am always happy to do a free illustration review for anybody. My email address is down below, or you can reach out to me through my website. But send me your illustration. I'm happy to take a quick look at it and give you some feedback on it as to whether or not the agent can increase the death or can decrease the death benefit, drive some of the costs out of the policy. So other than that, if you're hungry for more information and you're not ready to talk to an agent yet, then I highly recommend going out to my Facebook group, The Double Play. There's a link for it in the description down below. But that group is made up of a lot of like-minded individuals. There are people who are using the Double Play today that you can go on that forum and ask questions of them, and they'd be happy to answer. I'm on there all the time. I can answer questions as well. There's no commitment. You don't have to type your name or get on a list or anything like that. Just go there and post your questions, and there are people there who can answer your questions honestly because they're using it themselves. But otherwise, be sure to go through the list of channels on this website. The entire Double Play is covered in detail, from soup to nuts and everything in between. My website, innovativeretirementstrategies.com, I consider it to be a no-fluff zone. So there's tons of information there, blog posts that kind of replicate the content of these videos, but it's nice to go there and read it and print it out as opposed to having to try and find some place in the video that you want to get back to and read again or see again. So with that, I'd like to thank you for tuning in. Be sure to stick around to the end of the trailer just to kind of get some links to other videos that might be of interest to you. I'll see you in the next video. Thanks.